Hi and welcome to my channel. If you're a property owner in the UK, you know how important it is to make the most of your investments. That's why today we're going to do a dive into smart tax saving strategies that's going to boost the value of your bank account because it's going to put more money in your back pocket. And by the way, I'm 𝐻𝐶 and I'm thrilled to be sharing these tips with you. So let's get started right away. Tax saving number 1, rent a room relief. This scheme offers tax relief for renting out a part of your home. So if you're looking to earn extra income, which most people are, especially nowadays, this is a fantastic way to do it in my view. You could make up to £7,500 a year tax free, but remember there are certain conditions you have to meet, like having a furnished home and living in it yourself at the same time as having a lodger. Tax saving number 2 involves sharing rental income when you jointly own a property, especially if you're a married couple. So this is two people cohabiting and living together. By splitting the rental income profits in a way that benefits you and your life partner, you could save a bundle of tax. Tax saving number 3, annual exemption and property transfers. Moving on to this strategy, using your annual exemption and transferring property in stages is rather a clever way to transfer property from one person to another person as long as you are both married, and this way you can share the income. So if one is a high rate taxpayer and one is a basic rate taxpayer, the basic rate taxpayer can have more income and they pay rate tax at the basic rate, saving you tax at the higher rate. Number 4, let's talk about private residence relief as a good option. If you're trying to sell your property, this relief can help you save on capital gains tax. I'll walk you through a situation where this relief applies and how it can benefit you. PRR relief is available if the property is your main residence throughout the period of your ownership, and I'm making it very simple here. And similarly, PRR relief will be proportionally available by the number of days it was your home if you are also renting the property over a certain period of time. So if you lived in the property all the while and then you sell it, you pay no tax whatsoever. If you rented it for part of the time, you may have to pay some tax, and the last 9 months are tax free. Number 5, using a property management company. Strategy 5 involves using a property management company to your advantage. So if you're a high rate taxpayer, there's a way to set up a company and benefit from lower company taxes while still owning a property. But you're going to crunch the numbers to make sure it works for you, and it's going to be a proper bona fide arrangement. Moving on to saving number 6, maximizing your rental losses. Did you know that you can offset your losses from one property against another rental income property as long as you own that whole entire business as one? If you do, and one property makes a loss and the other property makes a profit, you can use the losses of one property against the profits of another. Number 7 is all about avoiding or minimizing capital gains tax on gifting a holiday home or a furnished holiday let. So if you've got a property that qualifies as a furnished holiday let, you're in luck. You may be able to take advantage of holdover relief. Holdover relief avoids paying CGT when a property is gifted. When you transfer the property to someone other than your spouse or civil partner by using holdover relief, you must sign a gift relief election. Under this relief, the capital gains is passed on to the person you've given the property to. You have now deemed that the property is sold at the cost price, so no CGT. The recipient of the gift, let's say your child, lives in the property and makes it or nominates it as their main residence. Tax saving number 8 is all about trust and using a trust and how it's going to save you potential tax. I'll explain how this advanced strategy can help you reduce capital gains tax in this particular example, especially when it comes to gifting properties to certain types of trusts. And this is a very complicated area, by the way, and there are different types of trusts. Now, property can be transferred to a discretionary trust as a gift. As with gifts, it is chargeable at the market value, but you can elect to have this gain held over and you will not have to pay any CGT. This gain will only be chargeable on any subsequent disposal by a beneficiary or beneficiaries. If you gift a property to a trust in which you have some sort of interest, you cannot claim gift relief. Having a minor child or spouse as a beneficiary is regarded as having some sort of interest in a trust. Strategy number 9 is all about maximizing your deductible expenses, because everybody wants to know what can they deduct. Capital expenditure is not allowed as a deduction while computing your taxable profits for income when it comes to property. However, the costs you incur in the day-to-day running of your property business are not capital expenses and can be deducted from your rental income. Costs incurred in significantly improving and enhancing the value of your property are considered capital and cannot be deducted against income. The distinction between repair and improvements is complicated and complex, as repairs are tax deductible but improvements are not. Even though the improvement cost cannot be deducted against rental income, it can be deducted while computing the capital gains tax at the time a property is transferred or disposed of, i.e. sold. Last and by no means least, and very important, is utilizing capital allowances. Now let's say you're into commercial property, or if you're into commercial conversions and you're running a service accommodation business, there's an opportunity to claim capital allowances on qualifying assets. I'll give you the lowdown on what assets qualify and how you can make the most of this particular tax saving strategy. Capital allowances cover a wide range of assets within a property, such as some fixtures and fittings, plant and machinery, equipment, heating and cooling systems, security systems, so on and so forth. The key idea is that you're allowed to deduct a proportion of the cost of these qualifying assets from your taxable income over a period of time, rather than deducting the full cost all at once. However, you can sometimes deduct all at once using the annual investment allowance, which is up to £1 million per year. So you couldn't do it all in one go too, depends how you do it. Different assets have different rates of allowances, and the government sets these specific rates out, and they can change at various times depending on what the Chancellor announces. Remember that capital allowances can significantly impact your tax liability, i.e. significantly reduce it. So it's crucial to understand the rules and regulations applicable to your situation. In short, capital allowances are a very valuable asset that allow property owners and businesses to receive this tax relief on long-term assets, which ultimately means you are going to manage and reduce your tax burden, and that saving of tax can be used efficiently to improve your operation and to scale your property business. And there you have it, folks. Those are my top tax saving strategies for you today, or should I say, those are some of my tax saving strategies for you, a property business owner. I hope you found these tips useful and there was at least one that piqued your interest or was new to you or was different to you. So make sure you don't forget to hit the like button and subscribe to my channel. Thanks for watching, and I'll catch you on the next video.